Welcome, everyone. Thanks so much for joining us for this analysis.
Great to be here.
If you find what we do here valuable, please do us a favor and hit that like button, share this, and of course, subscribe so you stay tuned.
And it really does help. If you want to support us making more of these, you can check out the channel membership options.
And super thanks is always there if you want to show a little extra support. Okay, so today we are cracking open the Marriott International Form 10Q.
A very dense document. This one is for the third quarter that ended September 30, 2025.
And our mission, as always, is to boil this all down for you. We want to find the most actionable bits of info on their results, the risks, and what they see coming down the pike.
That's right. And on the surface, the story seems pretty straightforward. It's profitable growth, mostly from their asset-light model.
Right, so they're making money from high-margin fees, franchising, management, not from owning the actual expensive hotel properties.
Exactly. But when you start to dig in, and we did, you find some really critical shifts happening just beneath those strong headline numbers.
Okay, so let's start with that scorecard then. Q3 2025 versus this time last year, revenue was up to $6,489 million.
Up from about $6,255 million. Solid growth.
But the net income, that's what jumped out at me. It surged to $728 million, way up from $584 million last year.
A huge jump. And while it shows great execution, there's a little bit of housekeeping in that number.
Oh, what do you mean?
Well, part of that growth was helped along by some insurance recoveries. They're related to that old Starwood data security incident from 2018.
Ah, I see. So it's a nice one-time boost, but not necessarily pure new operational strength. Still, smart to clean up old liability.
It's very smart. And you see that strength in the diluted EPS, too. It jumped to $2.67 from $2.07.
And their effective tax rate also crept up a little bit to 26.8%. They said that was because more of their earnings are coming from places with higher taxes.
Which is a big hint about where their growth is strongest right now. And looking ahead, they're guiding for full-year net rooms growth to approach 5%.
5%.
Yeah.
Okay, that's aggressive. And that actually leads us right into our 5 key takeaways from this filing. For me, the biggest surprise wasn't just the profit, it was the divergence in RevPAR. That's revenue per available room. Worldwide, it was only up 0.5%.
And get this, that entire 0.5% increase was driven by price increases, by average daily rate. The occupancy didn't drive it.
And here's the kicker.
This is the crucial detail, yeah.
In the U.S. and Canada, RevPAR actually went down by 0.4%.
Down, right. And that's because of softness in business travel and group demand. The only reason the worldwide number is positive is because of incredibly strong performance in international regions like Asia-Pacific and Europe.
So the U.S. market is stalling a bit, and the rest of the world is basically carrying the company's growth right now.
Which perfectly explains their next big move, doesn't it? The strategic acquisition.
The citizenM deal. They spent $355 million in the third quarter for that brand.
Right. And that adds 37 select service hotels. It's a massive signal about where they see the future, and it's a big part of how they'll hit that 5% rooms growth target.
So that brings us to capital deployment. How are they paying for all this?
Well, they're being very aggressive about returning capital to shareholders. They bought back 3.0 million shares for about $0.8 billion just in Q3.
Wow.
And they're funding these buybacks and acquisitions with new debt. That's why their interest expense jumped 15% this quarter.
So they're taking on more debt to buy back stock and expand, all while their biggest market, the U.S., is showing signs of weakness. Is that a risk?
It absolutely is. And that risk gets compounded by our 5th point. That Starwood data security issue just won't go away.
I thought you said they got some insurance money back for that.
They did. But in this very filing, the company states they are still unable to reasonably estimate the potential losses from ongoing litigation beyond what they've already recorded.
So that legal and regulatory cloud is still very much hanging over them?
It is. So if you tie this all together, you have a softening U.S. market, especially in those high-dollar business segments. So the real question we should be asking is, what is the long-term structural shift Marriott is preparing for? Is this aggressive international push and their focus on brands like citizenM a sign that they think U.S. business travel has permanently changed?
That is the big question, and something for all of you to think about. Thank you so much for diving deep with us into this 10Q.
Our pleasure.
If this was helpful, please hit that like button, share the video, and subscribe so you don't miss our next one. You can always support these deep dives through our channel membership, and of course, super thanks is always appreciated. We'll catch you on the next deep dive.